What's up, guys? Welcome again to my channel. So this might be the last episode for my working capital management lecture series. So as a matter of review, I have already uploaded four videos, I guess. Four videos. The first one will be the working capital management in general. I've also uploaded the inventory management in general, inventory management, receivables management, and cash management. So for today's episode, we're going to talk about payables, short-term payables management. Short-term payables management. Okay. So there are also chapters here. So the first chapter for this one is that I would like to tell you again about the concept of the receivable turnover, inventory turnover, inventory days or age of inventory. We have also age of the receivables, okay? And age of receivables or collection period. We have also payable days, okay? And payables turnover. We have operating cycle, and we have conversion period. So that's the first one. Although I think this particular review, it has been included already on the financial statement analysis topic, which I have to tape first. And this is just a matter of review. So meaning I'm assuming that you are really good in financial statement analysis already. Okay, so that's the first one. A review on financial statement analysis portions related to receivables, inventories, and payables. Okay? Now, the second one is I will have to compute the effective rates of the 3, 10, and 30. So, as accounting students, you already know what's the meaning of that 3, 10, and 30. So, those are credit terms. So, 310, that means you are going to enjoy 3% discount when you pay within 10 days. And N30 is none if you are going to pay 11th day to 30 days. So meaning the deadline is that 30. N30, the deadline is the 30 days later. Okay? So we have to compute the effective rate based on that credit terms. So the annual effective rate. And the third one that we're gonna do is we're going to compute also the effective rate for short-term loans. Although these three are very much related, so I'm going to as if make a storytelling so that we can connect these three. Okay? So the first one, again, is the concept about receivable turnover, inventory turnover, payables turnover, and others. So we have, again, the receivable turnover. Aside from knowing its formula, which is you put there the credit sales. Why credit sales? It is because you are only going to have an accounts receivable from this transaction. So we're going to use the credit sales. Okay? And then the denominator is the average receivables. So before we go to the other turnover, average receivables. That means when we talk about average receivables, we have accounts receivable beginning balance plus accounts receivable ending divided by 2. So this is what happens whenever we have a formula in financial statement analysis pertaining to balance sheet accounts like receivables. It is always averaged. Unlike this credit sales, which is an income statement item, you don't need to average that because you cannot average that because there is no sales beginning and sales end. Okay? So, that's receivable turnover. Okay? Now, without without going further to the other turnovers, let's discuss this first. Let me have some details or data. For example, it is 10 million and the average receivables is 100,000. So this 100,000 is again computed like this. Okay? So what will happen is that you will get 10 times. So why is it 10 times? So what is this receivable turnover, by the way? The receivable turnover is actually, so from, giving your customers, for example, credit, letting them buy services or goods from your company on account from that date. Okay? And then they're going to pay afterwards. And then they're going to uh, incur debt again from you. Okay? So again, they're going to incur debt from you, and then they are going to pay, and they are going to incur debt again. So that is a particular cycle. Okay? One cycle of that is what do we call as turnover. Okay? So meaning, if in a year you have 360 days, if your customers usually pays immediately, like for example, they are paying 360 times. So receivable turnover 360 times. So that would simply mean if they are going to incur debt from your company in the morning, they're gonna pay in the afternoon because 360 times, that would simply mean every day they are paying. So that's the meaning of receivable turnover. Let me repeat that. The receivable turnover, the formula is credit sales, the numerator is credit sales because you can only have an accounts receivable from this transaction. Because if it is cash sales, of course, it will not result to receivable. Okay? And then the denominator is the average receivables, which is accounts receivable beginning plus accounts receivable ending divided by 2. But the meaning of accounts receivable, aside from knowing the formula, is that it's the period, it's the number of times where your customers availed for credit from your company, and then they pay, and they avail again credit from your company. So that's one turnover. So how many times it will happen in a year or in an operation of your company is what we call as receivable turnover. Okay? So since you already understood that, as if you understood that, okay? So let's talk about age of receivables. Age of receivables or collection period or collection period is equivalent to your number of working days or operational days. Like for example, 360 days. It could also be other number of days depending on the problem. It could be 365 days or lower than that because your company is closed in Saturdays and Sundays, for example. You just follow what is given in the problem. Okay? But in this particular example, let's use 360 days divided by the receivable turnover of 10 times. So, meaning, on the 360 days, and if your customer is availing credit and then paying, availing credit and then paying 10 times, then that would simply mean 36 days is the age or collection period from the time that your customers on the average avails credit. After 36 days, they will pay on the average. Okay? So, meaning, the higher the turnover here, the better. Because it means that your customers are very much responsible in paying their responsibilities. Okay? And the lower the age of receivables, it's much better because you can have cash immediately after 36 days. Okay? So that's receivable turnover. And inventory turnover is something very similar to this. So on the inventory turnover, it's just cost of sales. So if you're familiar already with the computation of cost of sales, especially in merchandising and manufacturing, you will always see beginning inventory, ending inventory. So you can always remember this cost of sales because in the computation of the cost of sales, there is always a component there, inventory beginning balance, inventory ending balance. Okay? So that's cost of sales, and the same with this pattern. What the name is in this turnover, it's inventory. So you should only copy that name and you put average inventory. So what is the meaning of this one? So for example, let's copy the data. We have 10 million. We have 100,000 average inventory, in which the average inventory again is inventory beginning plus inventory end divided by 2. And you'll get also 10 times. So what is the meaning of this? It means when you are a manufacturing company or merchandising, let's have the point of view of merchandise of let's have the point of view of merchandising entity. Okay? So if you're a merchandising entity, so you are going to buy finished goods from somewhere, right? So you buy that finished goods and then you sell that. That is one inventory turnover. You buy inventories, you sell that, and you buy again. That's one inventory turnover. Okay? So, meaning, if your working period is 360 days, and then your inventory turnover is 10 times, it means there are 36 days when you buy inventories, and then you sell it. There is 36 days, and then you buy again. So, meaning, it's much nicer if the inventory turnover is higher, but it always depends upon the business, the nature of the business. Because if the nature of the business is somewhat like bakeries or something like that, this 10 times inventory turnover is not good. Because supposedly, in a bakery, you are going to buy raw materials and then convert it into finished goods and then you sell it. Supposedly, the inventory turnover for bakeries or businesses just like that should be higher, like 100 times, 200 times. Okay? But if we're talking about luxurious goods, like for example, cars, buildings, and etc., of course, the inventory turnover there is much lower because the selling of those items, the selling of those luxurious items is a little bit tricky than the bakery. Do you follow? But in general, the higher the inventory turnover, the better. Okay? And we have also the age of inventory or inventory days. So another name for age of receivables is receivable days. Age of inventory. The same with this one. 360 days working period. In this particular example, again, it can be 365 or any number of days as prescribed or as expressed in a problem that you are going to solve. So we have 360 days divided by 10, you have 36 days. So that means the inventory stays in your company for 36 days and then it will eventually be sold. Okay? Now, these two are very important because these two makes up the operating cycle. So if you are going to be asked how many days is the operating cycle, your answer would be uh, age of inventories and the age of receivables, which is again, that's age of inventory plus age of the receivables, which is in this case, we have 36 days plus 36 days, you have 72 days. So what is the meaning of this 72 days? 72 days is the timing of your cash inflow. So as you can see, we started with age of inventory. Normally, you will get inventories as a company, right? And then you will wait for it in order to be sold. Okay? So that's the 36 days in this particular example. That's age on the inventory. Buying of inventory and then selling it and then buying, that's inventory days, right? Now, in here in the operating cycle, it's as if it's assuming that when you buy inventories, when you sell it on account. Okay? Which is why the age of receivable starts. So, again, you buy inventory, you sell it on account, okay? And then from selling it on account, the customer will pay. And then you are going to the again. Um, again, the age of inventory is from the moment you buy the inventory and you sell it, okay? And in this particular operating cycle formula, in order for you to visualize, it's as if the assumption is you are selling those inventories on account. So meaning, from buying the inventories, you sell it on account, inventory days. From selling it on account and then the customer pays, that's receivable or age of receivables. So it takes 72 days for your cash inflow. Okay? So you buy inventories, after 72 days, you can collect. So that's the meaning of the operating cycle. Okay? So, what is the importance of this one? But before we go to the importance of the operating cycle, let's continue. We have also payables turnover. So accounts payable turnover, which is, it's similar with the pattern of the formulas. We have credit purchases in this case. Credit purchases because this is the only transaction that will result to accounts payable. So you can easily remember the formula. Okay? Because that is the source of the accounts payable of your company. Okay? And then, from the name, you have payables, you have average payables. Okay? So let's borrow again the simple data. We have 10 million, for example, credit purchases, and we have 100,000 average payables, and we will have still 10 times. So what is the meaning of that? From the moment you incur a debt from your suppliers to paying it, and then incurring a debt again, that is one payables turnover. You follow? So meaning, in your eyes, if you are paying 10 times and you are operating 360 days, so meaning you incur debt now and you are paying usually 36 days. Okay? But since we are in working capital management, as I've told you in the past, if we're talking about payables, you can extend as much as possible. If ever you are going to extend it, you can save money, right? Because your money will still earn interest because of the delay of payment, right? So go back to the cash management in order for you to understand what I'm talking about. So again, you have 10 times. You are incurring a debt from your suppliers towards payment. That's one turnover. Okay? So we have also age of payables. Age of payables is the same. Number of working days in an operation, 360 days. And then payables turnover of 10 times, we have 36 days. So as I have mentioned, every 36 days, you are paying your debt. You're incurring debt, and then you're paying your debt in 36 days after. Okay? So, how is it relevant on payables management? So, basically, if we're going to be strict about this, you should always compute for your operating cycle because this is related to your timing for cash inflows. And this is cash outflow. So from this, you can already see that this is bad. The timing of your cash inflows is 72 days and you are paying every 36 days. So that is bad. You follow? It is because if you're paying 36 days, where are you getting your payments? Of course, coming from other sources. For example, debt. And if you are incurring some debt, you are paying for cost of capital, like interests. And if your source of money for paying every 36 days is coming from the owners, you're paying for dividends. Okay? So as much as possible, this should be needed. Okay? So we have here the cash conversion period, which is the operating cycle, that's 72 days, minus the payable days. And as you can see, we have 72 here, we have 36 here, so we have a deficit of 36 days. And this is not good, because the higher the conversion period of your cash, or cash conversion cycle, that means there is a problem on your financing aspect. Because again, you are paying earlier than you're collecting. Okay? So, this is important in short-term payables management. Now, let's go to number 2. So, number 2, I've told you that we have to discuss how to get the effective rate from the credit terms. So, for example, you have a payable, and as if, on the average, your suppliers are giving you credit terms. Like for example, they're giving you 5, 10, and 30. So meaning, again, of the 5, 10, and 30 credit terms, If you pay for your obligation within 10 days, you are going to enjoy 5%. And there will be none after 30 days. And supposedly, there are penalties already right here after 30 days. So, let's stick to this. The question is, are you going to avail the discount? So basically, I'm telling you that it's not automatic that you are going to decide, let's avail the discount, let's pay within 10 days. Okay? It is because, as you can see here, if you opt to pay for 10 days, of course, there is a benefit. You are going to enjoy 5% discount, right? However, again, if your operating cycle is just like this, 72 days, where can you get the money to pay within 10 days? Of course, in other sources in which it requires paying for interest and dividends. Okay? So you have to compute first. Okay? Like for example, that is the whole case. Are you going to avail for the discount? First step, you have to compute first the effective rate of this 5, 10, and 30. And how do you do that? Of course, the first thing that you should get is the numerator because there are two fractions actually here. So let's discuss first the first fraction. The first fraction is the numerator is the discount rate, which is 5%. Okay? Now, in getting the real rate, because this is not the real rate, 5% is assumed to be coming from the 100%. So, this is actually not the effective rate if we're going to transform it. Okay? Actually, instead of saying that the effective rate is 5%, in which that is the ones mentioned here, it's 5% over 95%. So, it's higher than 5%. The effective rate is this one. So, that 95% is 100 minus 5%. The 5% is the discount rate. Of course, the 100% is the base. So, what will you get if ever? Let's compute. So, 5 divided by 95 times 100 in order to make it into a percentage. And you will get 5.26%. That is actually the percentage that you are foregoing every 10 days. Of course. Do you get me? So this is an effective rate, but not a yearly rate yet. So this is not an effective interest rate yet. So which is why we have the second fraction. In which the second fraction is 360 days. Based on our problem, that's 360 days. And then, you have the credit terms. So, we have 30 credit terms. This one to this one. And then, you minus the discount period and you will have 20. So, we're converting it into annual rate. So, meaning times 360. Because again, it's just for this. 5, 10, and 30. The 5% is relating only to 10 days and 30 days. So, we have to transform it into annual. So, 360 over 20. So, the annual rate is actually 5.26 times 360 divided by 20. And you will get, again, 5.26 times 360 divided by 20. You are actually foregoing 94.68%. Imagine, if ever, the characteristic of your debts is just like this, 5, 10, and 30. All of your suppliers, in general, are giving you 5, 10, and 30. Okay? The discount that you should have enjoyed if you are going to avail for such discount is 94.68% interest rate. Okay? Which is big, right? Now, let's talk about your source of funds. For example, you computed your source of funds to be having a cost rate of 60%. You loaned from the bank and you are to pay 60% interest. Of course, you will avail of the 5, 10, and 30. Of course, right? Because the benefit is much higher. You're gonna save a lot. 94.68% versus the 60%. So that's the second lesson. Okay? Now, the third lesson that I'm talking about is the computation of this. For example, this is the whole problem. You have 72 days operating cycle. So that's the timing of your cash inflow. You are to pay normally 30 days. Something like that. Or normally, you're paying 36 days as if you are delayed in the payment. Okay? As if like that. Okay? And you are looking for the best way for the company to handle these things. Like on the credit terms, are you going to avail the discount or not? So we have already computed here. Again, how do you get the effective rate? Of course, you have two fractions, the discount rate, and then the 100% minus the discount rate will be the denominator, and then you multiply it with 360 days so that it will become yearly because this is not yearly. And then 360 days divided by, of course, the credit, what do you call this? The credit deadline or the due date minus the discount days. So you have only 20 days. So that means 360 days divided by one period, which is 20 days. You have 360 divided by 20. I have not computed it. 360 divided by 20. You have 18 periods or 18 times this will happen. Okay? If each period is 20 days. So that would simply mean 5.26 times 18, that's 94.68%. That is the opportunity or the savings that you are foregoing if you will not avail the 5% discount. Okay? So, third lesson, how to compute this. Example, these are the data you are going to get from another source because your cash inflow is in 72 days pa. Okay? So, for example, you made a loan. A loan is 1 million, 50%. So this is usurious, but let's just assume because I have already made here 60%. So 1 million, 50%, but there are conditions attached. Number one, 10%. But is it really 10%? That is our goal here. How do you get the effective rate if you are going to finance using short-term debt? Because this is short-term payables management. So you have loaned 1 million. Let's not relate that example to this. Okay? Our third lesson is just getting the effective rate if you are going to incur debt, short-term debt, like short-term loan. So, you have 1 million as the principal. This is the interest rate, but there are conditions. The first one is there should be a 5% compensating balance. And also, the interest is deducted immediately. Interest is deducted in advance. These particular twists in the problem will make the effective rate not 10%. Because if the principal is 1 million and the interest is 10% and the maturity date is 1 year, that's the only ones that was given. Then, the effective rate is 10%. What makes this a little bit complicated? It's because of this additional given. So what will you do in order to get the effective rate of this one? So, here's the formula of cost of capital always. Whatever you do, this is the only a summary formula for the cost of capital. First, we have interest. Actually, that is net interest. Why net interest? You have your interest, this interest expense, right? But since there is a compensating balance, sometimes this compensating balance of yours, compensating balance, it means you have to leave a savings in the bank. So meaning, you cannot get the whole 1 million if ever. 1 million times 5%, that's 50,000. You have to keep it in the bank. That's compensating balance. So it's your money, of course. However, you cannot get that as proceeds. Now, that particular compensating balance sometimes earns interest. Okay? So meaning, you will have an interest income. So you have an interest expense minus interest income. That's net interest. Okay? But in this problem, I will not put there the fact that the compensating balance is earning also because this is too small. Okay? But that is net interest over the proceeds. So the proceeds is just the principal minus the deductions. That's it. And then you're going to get already the effective interest rate. Let's see. Let's compute. So based on this problem, you have effective interest rate is equivalent to, if we're going to substitute all this given to this formula, we have interest. So 1 million times 10%, that's 100,000. That's the numerator. And then the proceeds, again, that would be the principal of 1 million minus the compensating balance, which is 50,000, minus, because the interest is deducted in advance, you have 1 million minus 50 minus 100. And you are going to get, what is that? 850,000 only as proceeds. As the money that you're going to take home because of the loan, it's only 850,000. So, what will happen? 100,000 divided by 850, that's 11.76%. That's the effective interest rate or the real rate. So this is just the nominal rate. This is the real rate. Okay? So that is the ones that you are going to compare with this. The discount versus the cost that you are going to pay because you are availing for the discount and it is not in line with your cash inflows. And if ever the discount is much higher than the cost that you are paying in order to get money to pay for in 10 days in the discount period, then you avail for the discount. So that's the only twist here. So that's accounts payable and short-term payables management. Again, we have 3 lessons that I have told you here. The first one would be the concepts and the formulas of the receivable turnover, payables turnover, inventory turnover, receivable days or collection period, inventory days, and the payable days. Okay? And then we have the operating cycle and we have the conversion period. Okay? As well as the concepts of all of those. Number 2 is how are we going to get the effective rate or the effective discount yearly, annually? Because again, this 5% is pertaining only to the terms 30 days and 10 days. Okay? So we have talked about that. And of course, we have also talked about how to get the effective interest rate when you are going to avail a short-term credit or short-term loan. Okay, that's net interest over proceeds. So that's it for the working capital management. I guess I will upload a quiz B something, a surprise quiz B, as if we're going to answer working capital management questions, multiple choice questions, and let's see if I'm wrong or I'm right, because that would be not prepared, so impromptu answering. So watch out for that so that you'll be able to understand also how to analyze questions, multiple choice questions in order for you to be prepared on your tests, exams, quizzes, and etc. So thank you for watching and see you on the next video.